Mortgage boycotts are increasingly becoming the order of the day in present-day China, and the country's highly distressed property sector could very well spell even greater doom for the already turbulent Chinese economy. While China's Big Four asset management companies are presently battling with finding a solution to their bloated and overstretched balance sheets, the country's 56 trillion banking system is likewise facing the grim possibility of a 350 billion loss from mortgages and the property sector. The world's attention is now on Asia's giant, with the questions being asked about just how much wider the economic turmoil in China could get. Could China be on the verge of what would perhaps be the worst economic crisis of the post-pandemic era? How much doom does this dire economic situation spell for China and the world at large? Hang on as we explore the ongoing mortgage crisis in China and bring you detailed facts about the crisis that's never been discussed or reported before now. Let's dive right in. As the widespread protests continue to intensify all across China, Chinese authorities have in a peculiar fashion been clamping down heavily on protesters, using brute military force. Hundreds of thousands of young home buyers have continued to take to the streets despite all attempts by Chinese authorities to forcibly shut down all protests over further mortgage remittance until construction resumes at all stalled projects. Public confidence in Chinese asset management companies has been badly dented and eroded since construction work stopped in different regions across more than 90 cities in China. According to several experts on China, the ongoing mortgage crisis isn't a situation whose genesis dates back to only a few months when construction work stopped across all sites, or even more recently when mortgage payments were withheld by hundreds of thousands of homebuyers across China. To these experts, this was a crisis that started well over 2 decades ago when China struggled to contain the economic meltdown that spiraled from the infamous Asian financial crisis. And rather than adopt a long-term strategic approach to steadying the fast-collapsing Chinese economy at the time, Chinese authorities in Beijing opted for a rather crooked strategy that saw them set up a group of bad banks that were quickly loaded with the country's most toxic debt. These bad banks, which were all established in the 1990s, quickly grew far beyond their mandate and rose into financial conglomerates that were being majorly financed using debts from investors both home and abroad. Early glimpses of a brewing crisis became noticeable last year after Evergrande struggled to pay back its lenders and when Warong, China's biggest bad debt manager, had to be bailed out after the discovery of a 16 billion loss following months of delay tactics. With all of these underlying problems now surfacing and being impossible to defer any further, China's economy has fallen into an increasingly deepening state of economic distress. These bad banks have become evidently overburdened and presently unable to come to China's rescue. China's construction giant, Evergrande, which also happens to be the world's most indebted developer, has especially taken the spotlight in this fast-spiraling property crisis. The Chinese government is now faced with the challenge of finding a viable solution to the ongoing crisis without any help from the country's already debilitated superbanks. The real estate sector has increased and in recent years been one of the biggest drivers of growth in China's blossoming economy. The sector has consistently accounted for a third of China's 18 trillion gross domestic product, and it's not just China's economy that's come to be increasingly dependent on this sector. Recently released statistics show that about 70% of Chinese household wealth is tied up in the real estate sector. But with homeowners now blatantly refusing to pay mortgages on properties acquired due to the failure of developers to finish them, the whole situation is spiraling down quickly. So far, listed Chinese banks have reported only about 2.1 billion yuan in unpaid mortgages that have accrued from the boycotts. But some of the world's biggest financial experts like S&P Global and Deutsche Bank AG are already forecasting that China's financial system is at risk of losing as much as 2.4 trillion yuan, or approximately $356 billion in delinquent mortgages. This forecast also implies that about 7% of home loans in China are in danger of default, and there's a possibility that this figure could rise even further. With the rampant debt crisis among developers in China and the incessant COVID-19 restrictions that's already forced developers to halt construction on thousands of projects across mainland China, it's unknown just how much deeper this mortgage crisis will get. Chinese banks appear to be helplessly caught in the middle of this whole turbulent situation, according to finance experts in China. They appear to be in a situation where they are compelled to necessarily help the developers to finish all pending projects, to avoid losing much more. By doing so, they'll be further increasing their exposure to more delayed property development projects. But with Beijing placing financial and social stability as its top priorities following a seemingly prolonged period of COVID-induced slow economic growth, coupled with a rather unusually high rate of youth unemployment, experts are likewise predicting that the banks might get some assistance from the Chinese government. To aid the situation and possibly stop the ongoing boycotts, the China Banking and Insurance Regulatory Commission has repeatedly pledged to provide active credit support to property developers in a bid to help them complete all stalled projects as soon as possible. These announcements have, however, had very little impact on the Chinese populace, especially among these frustrated homebuyers who largely see the announcements as a ploy to get them to resume paying back their mortgages. The Commission, which is China's most superior banking regulator, has even urged all banks in the country to issue more mortgage loans to qualified homebuyers to boost demand and aid quick recovery in the property market. Available data have shown that a substantial amount of mortgage loans were issued to first-time homebuyers, pushing the existing lending space for property-related loans in China to its fastest pace ever since 2019. As of June 2022, new developer loans likewise issued by banks also reached 52.2 billion yuan, or approximately $7.7 billion. All of these moves were in response to a cut in mortgage rates by the People's Bank of China for first-time homebuyers in May. The ongoing refusal of protesting homebuyers to resume paying mortgages, especially on unfinished projects, is now raising concerns about a financial crisis in China and the rapidly brewing social unrest that would follow. The Chinese government in 2020 started cracking down on excessive borrowing by property developers in an attempt to regulate their high debt and curb increasing housing prices. This move by the Chinese government in 2020 resulted in an unprecedented cash crunch that left many developers cash-starved and completely unable to proceed with construction work. As the situation stands, the crisis is yet to show any sign of cooling off, especially as all moves by the authorities at finding a solution have been met by scorn by angry homebuyers. With China's laws allowing real estate firms to sell homes to prospective buyers before completing them and using the funds to finance construction, public anger is growing, especially as the vast majority of homebuyers had started repaying mortgages on the properties even before they took possession of them. The continuing mortgage boycotts, if not quickly reined in by the Chinese authorities, could cause sales to decline further and result in a much bigger cash problem for developers. Sustained boycotts, as experts are already predicting, will further cause prolonged project delays and debt defaults, and could essentially birth a vicious debt cycle within the Chinese properties market, unless the authorities make headway quickly enough in getting needed cash to developers and making homebuyers resume mortgage payments. This crisis could place a debilitating strain on China's economy and financial system, especially as the real estate sector and its related industries account for as much as 30% of the country's GDP. A debt restructuring might ultimately be considered by Chinese authorities, especially as all moves so far seem not to be generating the expected result, and as the world's second-largest economy struggles to avert a looming recession, Chinese middle class is the most affected by this crisis, as they make up the bulk of homebuyers and have a lot of their money invested in the real estate sector. Will China survive or collapse? It suffices to say that the next weeks are highly crucial, not just to the survival of the Chinese economy, but to the global economy at large. Make sure to give this video a like, hit the subscribe button, and smash the notification bell to receive updates on when we post more intriguing stories about global finance and investing.